My name is Jake, welcome to the channel. In today's video, we're going to talk about dividend investing with a low risk tolerance. 4 years ago, in 2018, I was lost. I was in a career that I thought was really something that I was proud of. I was making a lot of money, but I really didn't understand what my long-term goals were. I didn't understand where I was going to be in 10 years, 15 years. I didn't really know where my career was going to go. I knew that investing was important. I knew that it was something that I should be doing, but honestly, I didn't really understand what I was doing. I didn't understand how to truly build wealth. I tried investing into penny stocks. I tried investing into companies that, I tried to time the market. I would watch when companies would fall 10 or 20% in a week, and then I would buy them because I thought, buy low and sell high. Right? I thought, be greedy when others are fearful. I tried that, and for whatever reason, it just never worked out for me. I was incredibly bad at timing the market. I knew that I had to invest. I knew that I had to do something. Otherwise, I was going to work until I was 65. And I was just looking at myself. I was looking inside and I was like, man, this is really stressful. I'm in a high stress career. I work, for those of you that don't know, I'm in a sales position. I'm a sales director. And so I'm always constantly being evaluated by my, either my performance or my team's performance. It's a high risk, high reward type of environment. And I knew very early on that I couldn't do this forever. To keep these stress levels going forever, I'm not going to live a very long life if I have to keep up this high stress, be in this high stress environment. And so I was doing some research and I stumbled upon dividend investing. And once I stumbled upon dividend investing, everything really started to click. You have that light bulb effect. I really understood that, wow, this is something that I can stick with and that I can build wealth over the long term. I don't have to worry about buying low and selling high. All I have to worry about is making sure that I'm dollar cost averaging into my portfolio and that I'm picking sound investments, businesses that are growing and have competitive advantages. Really, that's really the main thing that I want to focus on. And so for me, there was always this anxiety and this stress around buying low and selling high. And once I found out about dividend investing, everything just made so much sense. And it really made me so happy and so calm about my future because it wasn't so much about luck and timing. It was a slow path to wealth, slowly, gradually building up a portfolio that I will one day be able to live off of and live off of the cash flow or the passive income from the portfolio. Now, fast forward 4 years and I've learned quite a bit. I've been investing into this strategy for about 4 years now, and there's a lot of things that I've learned. There's some things that I've done wrong, and I've tried to share those things here on the channel, here on YouTube, with all of you. So in this video, I want to talk about 6 things that your average person can do to invest into a dividend growth strategy with a low risk tolerance. The first, we're going to talk about, investing into businesses that you understand. Second, we're going to talk about investing into low beta stocks or ETFs and what that means. And then third, we're going to talk about investing into broad-based low fee index funds and ETFs and what that means. And then fourth, we're going to talk about investing into defensive stocks and sectors. Fifth, we're going to talk about investing into businesses with a competitive moat. And then lastly, we're going to talk about not timing the market. So whether you're a brand new investor or you're a seasoned investor and knows what they're doing, I think this video is going to shed a lot of light on some of the basics around dividend investing with a low risk tolerance. Because I'm sure there's a ton of you out there that have just started investing into the stock market after the pandemic, and you've only seen the market go up until the last couple of months. I'm sure if you're a new investor and you just started investing in April of 2020, you're probably feeling a little like this.
At least once a year, I like to bring in some of my Kevin's famous chili. Everybody is going to get to know each other in the pot. I'm serious about this stuff.
Oh my gosh. Oh man. Okay. Now, the first way to tackle dividend investing with a low risk tolerance is to start with investing into businesses that you understand. Now, I have been sharing this on my channel for years now. This is so important for a couple of reasons. The first reason is you want to make sure that when you're a new investor, you understand that what you're investing in is a business. A business can be profitable, it can be not profitable. And when you're investing into something that you're either a fan of or maybe a consumer of, it makes it a lot easier and more tangible for your normal person. If you shop at Costco on a monthly or a weekly basis, you understand the model and how Costco makes money. If you're investing into, or if you, let's say for example, in your lunch break, you go and you buy McDonald's, you can invest into McDonald's. If you really like to snack and you're a snacker on the weekend, you may invest into Lay's, into Pepsi, or maybe you really like chocolate and you invest into Hershey's. The main thing here is if you're going to invest for the long term, you want to invest into businesses that you understand. And the big reason why this is important is you have to have conviction in these companies. It's very easy to invest in the stock market when all the stock market does is go up. Every week you hear about new all-time highs. It's a lot more difficult when you're seeing your portfolio in the red and you see your portfolio go down in value. And you start thinking, oh wow, I just worked all year last year and everything that I invested is now down or worth 50% less. This can be very detrimental and really cause bad habits if you don't know why you're investing and what you're investing in. And what you're investing in is a business. And so when you see the share price go down, you have to ask yourself, well, has anything changed? When you're investing into Costco, has anything changed, or at Target, right? What has changed to make the share price go down? If there's nothing changing to the fundamentals, then it's just, the market conditions that we may be in. But the key thing here is invest in what you understand. For when the storm comes, you're going to be able to hold on, and you're not going to be one of those that quickly goes and sells your shares at a loss. That's the key thing here. The next way that you can invest into dividend stocks and be a dividend investor with a low risk tolerance is invest into businesses and ETFs with a low beta. So it's important to understand what beta is. Beta is the comparison of the volatility of that investment compared to the overall market. So for example, a company can be more volatile than the overall market or less volatile than the overall market. And so the overall market would be, for example, the total US market. Right? The total US market would be, for example, the S&P 500 has a beta of 1. Right? And if the company or the ETF that you're investing in, if they have a beta over 1, then that means you're more volatile. You're in a more volatile investment than the overall stock market. Now, if that investment that you have is less than 1, then that means that there's going to be less volatility in that investment compared to the overall stock market. So how this can help you is if you understand that you really are risk averse and you want to avoid all the volatility, you can intentionally look for investments that have a low beta. And so there's many websites out there that will show the different beta of individual stocks. One that I personally like is from Sure Dividend. Sure Dividend, they're great when it comes to sharing different information on, dividend investing research. But what you can do is you can go over to Sure Dividend and you can look at their 2022 low beta stocks list. You can see some of the lowest beta S&P 500 stocks here on this website. What you can do is you can go and you can click on this link here. I'm not affiliated with them. I just love their research that they provide for free. You can click on this link here, you can enter in your email address, and what they'll do is they'll email this spreadsheet over to you, and you can take a look at the research here that they have, and you can filter here by beta from lowest to highest, and you can see, okay, some of the, some stocks that have a low beta. But if you go down here to the bottom left under the performance tab, here they have primarily dividend stocks, and you can filter by the beta, by beta here, and you can do largest to lowest, right? You can see, okay, the ticker symbol here, Nexair Energy, ADM, WMB, et cetera, and you can see all these different dividend stocks that have a low beta. And this is a great place to start when you're looking at individual stocks. And if you're investing into ETFs, you can go to ETF.com and you can scroll down and you'll be able to see, if I can find it here, over on the right, you can see the beta of this ETF. You can see here the what beta stands for. But if you were to invest in a DGRO, you're actually getting a lower beta than the S&P 500. So the reason why this is important is the weighted average of the investments, the companies in this ETF, represent a lower beta than the S&P 500. And that's how you can find this out for yourself. So if you're going over here to ETF.com and you want to check out other ETFs, and you can scroll down and you can see what the beta would be. And this is a great way to invest in a dividend investing strategy if you know that you have a low risk tolerance, right? And the key thing here is it's really just talking about the volatility, right? The share price is still going to go up and down, but it's not going to be as volatile like the broader market. And that's why beta is important when understanding volatility in your investments. The next way that you can invest into a dividend strategy, if you have a low risk tolerance, is to invest into low fee index funds or ETFs. This is a great way to get exposure to the stock market. Really, you're a dividend investor whether you invest in individual stocks or ETFs. I know that there's a big debate out there that, dividend investors are, not as good as, individual stock pickers, right? Specifically when it comes to dividend investing. And I call BS. You're a dividend investor if you invest into individual companies or into ETFs. It really comes down to what your core strategy is. And so I don't want anybody out there thinking, I'm not a real dividend investor unless I invest in individual stocks. BS. You can get even better returns in many cases if you invest into high quality ETFs. And that's what I personally do. I invest into both. Some of my favorite ETFs out there for dividend investing when it comes to a low risk tolerance is I like focusing on ETFs where the companies in that index are screened for dividend growth. So what that means is these indexes are holding companies that have growing cash flows, that they're growing their earnings per share, and they're rewarding you and I as shareholders in the form of a growing dividend. And so when I'm investing into dividend stocks, I really like there to be a growth component. And for me, that's the cream of the crop when it comes to dividend investing, is you're getting an annual increase in your dividend income. So some of my favorite ETFs that I love for dividend investing, I love the Schwab SEHD dividend ETF. And the important thing with these ETFs is they all follow an index. And I've made an entire video on this, but the important thing here is you understand the index that this ETF is following. So for example, with SEHD, this ETF is following the Dow Jones US Dividend 100 Index. And if you don't know what that means, I'd recommend going over to my channel here. If you go under the videos tab, you can see that I've made an entire video on this topic, walking through and explaining everything that you get with the SEHD ETF. I've also made it on DGRO, and I've also made it on VYM. So if you're interested in those ETFs, I do really in-depth analyses around those ETFs. But that's another way that if you're a conscious investor and you know that you have a low risk tolerance, investing into high quality ETFs is a great way to still get exposure to the stock market, but lower your volatility and lower your overall risk, but still staying invested. So the next way that you can invest in a dividend investing strategy with a low risk tolerance is invest into businesses that have a competitive moat. Really, the key thing here to understand is you're investing into a business that has a competitive advantage, something that another company can't just come in and take market share away from that company. So for example, you have a company like Coca-Cola or PepsiCo, right? Really well-established businesses that most people in the world understand. And there's many different forms of a moat. A moat can be in their supply chain. It can be in their IP. It could be in their brand recognition. There's many different ways around, understanding what a competitive moat is. Okay. And so when you're investing into individual stocks, you can look for attributes like that. How difficult would it be for another company to come and disrupt this other company that you're investing in? And so some of my favorite investments are, for example, really blue chip, well-established companies like a Coca-Cola, a Pepsi, companies that have been around for decades, that have weathered the storm in the past and have really that brand recognition. So if you understand that you have a low risk tolerance, take a look and see, okay, what kind of businesses are out there that have really this competitive moat around them that protects them from outsiders coming in and stealing market share from them. Okay. And if you do want to take a look at, if you want to gain inspiration, there's a lot of ETFs that are theme based on this. And so if you want to get some inspiration on some companies like that, you can go to Morningstar, for example, and you can take a look at, the research that they've done on this topic. But if you just go look at the ticker MOAT, pretty unique name, right? You can take a look and you can see some of the holdings in an ETF that is focused on the Morningstar moat research and, investing strategy. So a few, for example, Altria, Merck, Lockheed Martin, Bristol Myers, Wells Fargo, though you could, debate a few of these, what that means. But as I mentioned, a moat is not just one metric. There's a handful of metrics that go into calculating whether or not a company has a moat or not. But for your average person out there watching this video, you have to ask yourself, could you imagine another company coming in and taking market share away from this company? And so those are the kind of things that you can start thinking about. And once again, if you don't want to do this, if you don't want to take the risk of investing into individual stocks, what you could always do is invest into a low fee index fund or ETF that does it for you. So always something to consider. The next thing that you can do if you know that you have a low risk tolerance is you can invest into sectors that are less volatile. So some of these sectors have a lower beta. For example, we talked about beta earlier. So beta is the volatility. Some of these are more defensive sectors. For example, consumer staples or utilities. When I think about defensive sectors, I usually gravitate to those two, utilities and consumer staples. The reason why I gravitate to these are the sectors that generally do very well in a recession. And when there's a slowdown or when there's, not as much money printing going on, people kind of tend to gravitate towards those sectors that are cash flow positive, that are generating cash flows today, and where there's an underlying need behind that product or service. People have to eat, people have to have energy or electricity, things that people really can't go without. And so you think about this discretionary versus non-discretionary. Discretionary is something that's great when you have money and things are doing well. But when things are not doing so well, or when there's tightening going on, people are kind of more conscious of their budget. They're then focusing more on the necessities of life, things that they can't go without, right? And so those are the things that I think about. And so if you're a consciously risk-averse person, then what you could do is you could say, okay, well, I don't want to have the volatility. I would rather invest into sectors, ETFs, indexes, or individual companies that are part of more of a defensive sector. Okay. And so what I want to do is I want to back test something that may shed a little bit of light on this. So what I wanted to do is I wanted to take a look at the SPY, the XLU, and the XLP. These are all indexes, right? So the SPY is the total S&P 500. Right? So the top largest 500 companies in America. The next, the XLU, is the sector for utilities, and XLP is for the sector or the index consumer staples. And what I wanted to see is how do these indexes perform over time, and what does that volatility look like? So right off the bat, the thing that I really want to highlight before we look at the individual years, this is the key thing. If you were to have invested $10,000 back in January of 1999, so right before the big tech bubble, right? You would see, if you see this annualized and compounded annualized, this includes the dividend reinvested, you can see that the S&P 500 would have yielded the highest return of the three, but not really by far, right? You see the utility sector is really, really close, just very similar to the S&P 500, but staples actually did underperform about a percentage lower than the S&P 500. But the thing that I want to talk about, if you know that you're a risk-averse person, this is the thing that you want to take a look at. The worst year that you would have noticed in this of the three is you would have only seen it's all relative, only negative 20% in a single year compared to the S&P 500 with a minus or negative 37%. But on the flip side, the best single year during this time period was 32%, whereas with consumer staples, the best year was 27%. So this is the key thing. If you're a risk-averse person, the key thing is you don't want to see all that volatility, right? And maybe if you really, really want to be risk averse, then you could go and invest into treasuries and bonds. But I think the audience here on YouTube is completely, I don't think that that's really the audience watching my channel. So I'm assuming that you want to invest in the stock market, not into bonds. And so these are some things that you can do if you still want to be invested in the stock market, into equities. These are things that you can kind of look at and consider, right? And so what I want to show here is if you look back from 1999, the blue being the S&P 500, red being utilities, and orange being staples, consumer staples, you can see that not every year they performed the same, right? Back in 99, you can see that the S&P 500 crushed staples, but the following year in 2000, staples and utilities crushed the S&P 500. And so the key thing here is if you're a long-term investor, you have to understand that there's always going to be volatility. The stock market is going to go up and down. And so unless you want to hold money in a checking account and get next to zero interest and lose your money to inflation, you do have to take some level of risk. And because you are taking risk, the market is going to reward you for that over the long term. In the short term, it's going to feel like a really, really bumpy ride. But if you look over the long term, you can see, on this graph here that, yeah, there's definitely volatility. But if you're invested for the long term and you're thinking in decades, that's how your average person is going to come out on top and really grow wealth. Coming back to this chart down here, you can see that, during the worst of times, during the 2008 financial crisis, you can see 2008, the S&P 500 performed the worst, but then the following year, it performed the best, right? And then you can see in 2011, it performed the worst, whereas utilities performed very well. And then if you look at, let's say, for example, let's take a look at 2021. So last year, S&P 500 did very well. If we look at here, the first 2.5 months into 2022, the worst performing is the S&P 500 and the best performing is consumer staples. So that's the key thing here, is understanding the volatility, understanding, how these different sectors are performing over time. And the last way here that you can invest with a low risk tolerance in a dividend investing strategy is to not time the market. Focusing on dollar cost averaging is really, over the long term, the best way for your average person to build wealth. And that's what it comes down to. If you have a short-term mindset, you're going to drive yourself crazy, right? I shared that story at the very beginning of the video here. Before I came across dividend investing and dollar cost averaging, I felt lost. I had no idea what I was doing. And once I understood that I don't have to beat the market, I don't have to be right, wins the top, wins the bottom, when to get out, when to get in. I don't have to have all the answers. All I have to do is focus on getting money into my checking account from my earned income from my day job, pick the right investments for me, for my time horizon, and dollar cost average into them. If the market is going up, so be it. If the market's going down, so be it. You can buy in at a discount. But the key thing here is really controlling your emotions and understanding that no one, and I mean no one, can accurately time and time again time the market. And if you have a low risk tolerance, this is a huge weight off your shoulder, knowing that you don't have to have all the answers. You don't have to time the market. And it makes it so much easier and so much more enjoyable over the years as you're investing, as you're building your wealth, and as you're enjoying your life. Investing is only a small part of our lives. We should be enjoying the rest, enjoying our lives, right? Especially if you're like my wife and I, who are looking to pursue FIRE. And something that I try to remind myself over and over again, it's not always about the destination, it's also about the journey. Thank you so much for watching, everybody. I hope that this video was helpful. I hope that you understand that not everyone has the same risk tolerance. Someone may be completely different than you, maybe in a complete different situation and circumstance in life. The important thing is that you understand yourself. You have to really look from within and understand what is your risk tolerance. And there's nothing to be ashamed of. There's nothing wrong with having a low risk tolerance. It's important that you understand that everyone is in a different situation and you have to do what's right for you. Thank you so much for watching, everybody, and I'll catch everyone in next week's video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.